It starts quietly. A flicker on a screen. A sudden spike in volume. Prices shift before you even blink. To the average investor, it's just market noise. But behind the scenes, a different game is being played. One where hedge funds control the board, write the rules, and move faster than you ever could. Imagine you're buying a stock. You hit buy at $10, but by the time your order executes, it's $10.05. That sliver of a difference? That's not luck. That's a hedge fund's algorithm front-running your trade, detecting your intent, jumping ahead of you, buying the stock first, and selling it back to you for a profit. You never saw it happen, but they made money off your move. This isn't theory. It's high-frequency trading. Speed is the weapon, data is the ammunition, and the battlefield is the very infrastructure of the stock market. Hedge funds spend millions to place their servers physically closer to stock exchanges, just to shave off milliseconds. In a game where milliseconds mean millions, you're not just late, you're invisible. Then there's dark pools, private exchanges where big players make trades away from public eyes. You can't see the order book. You don't know the price, but hedge funds do. They use this information imbalance to predict movements before they hit the open market. They win before the game begins. It gets worse. Hedge funds lobby for rules they helped draft, exploit loopholes they helped write, and when things go wrong, they rarely pay the price. Retail investors, on the other hand, are left holding the bag, again and again. By the time you notice the pattern, they've already cashed out, and the cycle starts all over again. The market isn't broken, it's rigged, just not for you. You might think regulation would stop this, that someone, somewhere, is watching the watchers. But the truth is more unsettling. Many of the people writing the rules used to work for hedge funds. And when they're done writing those rules, they go right back to those firms with fatter salaries and insider influence. It's called the revolving door, and it's wide open. This isn't conspiracy. It's strategy. Hedge funds don't just game the system, they help design it. They fund think tanks, pressure lawmakers, and flood the market with lobbyists who whisper in the right ears. And while politicians talk about protecting the little guy, the real changes happen behind closed doors, with handshakes, campaign checks, and vague promises of reform that never materialize. Look at short selling. When a hedge fund bets a company will fail, they don't just wait, they make it happen. Coordinated media leaks, aggressive short positions, and manufactured panic. They can collapse a stock within hours. And when retail investors finally panic sell, that's when hedge funds buy in cheap. It's not just financial prediction, it's financial manipulation. And then there's options trading, complex contracts that most people barely understand. Hedge funds use them to disguise moves, mask intentions, and hedge losses before they even happen. It's like watching someone play poker with X-ray glasses while you're guessing blind. When things get too hot, they pull strings behind the scenes. Trading halts, liquidity limits, technical glitches. We've seen it before, like with the GameStop saga. When regular investors flipped the script, suddenly the rules changed. Platforms restricted buying. Trades were delayed, and hedge funds were protected. Again, you keep playing by the rules. They keep changing them. And if you lose money, that's your fault, they say. But if they lose, the system bends until they don't. But here's the twist most people never see. Hedge funds don't just profit when stocks go up or down. They profit off volatility itself. Chaos isn't a risk for them. It's an opportunity. Every market crash, every economic downturn, every global crisis becomes a playground for profit. While the world panics, they position themselves to win from both sides. Think back to 2008. While millions lost homes, jobs, and retirement savings, a handful of hedge funds made billions by betting against the very system they helped inflate. They didn't sound the alarm. They stayed silent, took their positions, and waited for the collapse. Then they collected their winnings while the rest of the world tried to rebuild from ashes. It's happening again, just in new forms. During the pandemic, while small businesses were closing and people were lining up for food banks, hedge funds were making record profits, exploiting every dip, every government stimulus package, every delayed reaction. They're not reacting to the market. They're shaping it. And how do they stay so far ahead? Data. Not just market data, but everything. Credit card transactions, satellite images of parking lots, even social media sentiment. They know where money will move before it does. You're trading off news. They're trading off tomorrow's news. Retail investors talk about diamond hands and holding the line. But hedge funds, they don't hold anything. They rotate, hedge, short, and swap positions in microseconds. By the time you decide to enter a trade, they've already entered, exited, and made their profit. And when you finally catch on, when the truth starts to leak, they shift strategies again, change the narrative, create distractions, blame the retail crowd for instability, and the cycle repeats. Because for them, the game never stops, and for you, the rules never stay the same.